I'm going to do another trend trading video and kind of do a little update on where we are so far. So I've been looking at these basic trend trading ideas with various fixed targets, and we've looked at 10R, 4R, 3R and 2R, and what we can see is a pattern forming. Okay, I've tried various the entry has always remained the same. Okay, so we're looking for sells, we're looking for a bearish close and a breakout of the low, and vice versa for long. So a very simple entry system, and then a pullback, and then another trade setup can happen there. And we've looked at adding aggressively and adding conservatively. So aggressively, you could just say take every setup regardless of where it happens, as long as it's with the trend rules. Okay, and we've looked at only waiting for price to move to a new level and retrace. So your trades are always stepping in the direction that you're trading. Okay, and with all of those, the scenario, what we learn from it is essentially the same. Okay, so with the 4 to 10R, okay, so let's call this high risk to reward fixed targets. Okay, these generate the best returns by a lot. Okay, and I've been testing gold, euro, yen, and pound dollar, so kind of sticking to the major pairs really, and I've just been testing this year. Okay, and 4 to 10R, okay, you're going to generate the best returns. And I think it was 4 to 10R, I think they were around 2 to 300 R a year. Okay, 2 to 300 per year. But the downside is they also generated the highest drawdowns, so they had in the region of 30 to 40%. Okay, I'm not going into like massive detail with the figures here, because we're just kind of trying to make a basic point. Okay, which is a fairly obvious point, but it's all part of the process of developing trading systems. Okay, then when we drop down to 3R, we saw that the returns, as you'd expect, were much lower, markedly lower actually, but at the same time we also reduced our drawdowns. Okay, and even right down to 2R, there was still decent returns, but very low drawdowns. I think the most I got to on 2R was something like 11%. That's risking 1% a trade. Okay, and the downside to this is the returns were much lower. I think they're like something like 50 to 80. Okay, and there was long periods on the 2R where you essentially go nowhere. +1 all square, +2 -1, +3 +1 all square, like this for ages, and then you get periods where you get a nice sustained move like this, and that's where you kind of secure some actual profit, and then you go into kind of breaking even for a period again. Okay, now in terms of the amount of risk you take on compared to returns, then 2 is probably the best, and 4 to 10 in terms of returns is clearly the best, but it comes with much higher risk. And with all of these, what you find is the wins and the losses tend to clump together. They're distributed in clumps, so it's not even. So it's quite likely that all of this drawdown is going to come in one hit, and then you're going to have periods where you're just winning. Okay, so that poses some issues if you're already 40% down. You've actually got to win more than 40% to get back to where you originally were if you're using a fractional money management technique, risking 2% of your available account on each trade. As you take this drawdown, the amount you're risking is actually going down each trade, so it takes you longer to recover those losses. Okay, so in an ideal world, what we really want to do is we want to trade this span of risk to reward, 2 to 10, so we can deal with this downside, but also give us a possibility of hitting these much higher returns. Okay, so just going to look at a kind of simple way of perhaps achieving that. And then the obvious idea is to use a trailing stop. So what I've looked at is use a trailing stop, and also use some way of stopping trading when price is going against the higher time frame trend, if you like. So in all of these, we've been looking on the 30-minute time frame with the 480 period simple moving average to identify the trend, okay, which is in effect the 10 period on the daily time frame. Okay, so if I just that's a 20 there, but this is a 20 period moving average, but you can see that price does these nice sustained moves above and over on the daily time frame of these fairly quick moving averages. Okay, so when the daily is doing this, we want to have lots of shorts on the M30, okay, because you can stack up really nice big runs of wins then. Okay, and so that's why I've been using the 480 on the 30-minute time frame. The downside to this is that you do get let me find a good example. When you've had a long sustained trend on the daily in one direction, you do get quite a lot of these periods where the trend is clearly sort of changing, but you're still looking for longs in this period. Okay, so if we can perhaps deal with that slightly as well, that is going to help. It means that we can still aggressively stack trades and really make big money when price goes with the trend, but reduce the damage when price is going against the trend. Okay, so the easiest way to achieve that is to use the pattern of higher swing highs and higher swing lows. So if we look at this period here, we can see we're above the 480 period moving average, and we're making patterns of higher swing highs and higher swing lows. Okay, and all you really need to do is mark out these swing lows as price moves in your direction. Okay, and at the time that price breaks that pattern, okay, then you just need to do the same in the opposite direction before you start to trade with the long-term trend again. Okay, so here you can see the long-term trend changes to down, and we keep selling and tracking these swing highs here until that pattern is broken, and then we pause until the pattern starts again in the direction. Okay, almost started there, it continued long. Then you can see here it does start again, and then we continue to trade short. Okay, marking our swing highs as we come down, waiting for the pattern to be broken, and all this time we're aggressively stacking our entries short. Okay, so that's a nice real simple way of trading this sort of daily trend aggressively on the lower time frame. And then to deal with the idea of getting a broad span of risk to rewards, and the easiest way to do that is to say, okay, well, our minimum target is 2R, okay, and our max target is 10R. And rather than setting a TP, when you take your entry here, you wait until price hits your 2R, and then you manage your trade. Okay, so rather than having a fixed exit here, you manage your trade. So there you just go through the basic options. You can move to break even, you can trail your stop up tightly, or you can just close and take your 2R. Now a lot of the time you're just going to get your 2R, or you're going to get slightly less than 2R if you used a trailing stop. But the advantage this gives you is those trades where you take your entry and price quickly drives to 4R, okay, or let's say you trailed your stop at the 2R here and then it pushed on again, then you're going to get your higher risk to rewards like 4R and so on. And not often, but you're also going to have, you know, the occasions where, let me find an example, like here, where you know, you could have, say, been in this trade here and it hasn't quite hit your 2R yet, and the next bar does this, and you get a very big winner, a 10R or whatever. Okay, 5R, 10R. Now these aren't going to happen often, but just by adjusting from a fixed target to like an open management at 2R system, then you put yourself in with the possibility of catching some really big wins as well. And when you're trading at these lower risk to rewards as well, these are going to be more significant because your drawdowns are going to be on the whole shorter and less than if you're just holding for the big wins. So this kind of generates quite a nice middle ground, really. You deal with the periods where price is perhaps marked as a downtrend, but it does this, okay, and then when price really moves strongly in your direction, you can win a lot of consecutive wins and the possibility of some very big wins as well. And you'll find that when look at last week on gold here, you can see that we're below the daily trend, so that was short. Okay, and we were tracking these swing highs for price to turn and go short again, and this stops out. Then if you were stacking aggressively down here on after every retrace, you can see you get these breakaways where you have multiple positions all going over their 2R target. So this gives you nice flexibility. You can close this one out at 2 or 3R. You can trail the stop up on this one, and you can perhaps put this one just to break even. Okay, and then continue to aggressively stack your trades as price comes down and retraces. Okay, and these periods are where your returns are really going to jump, and it feels uncomfortable to stack these trades like this, because technically it looks like you're just randomly entering trades, and essentially you are, but the system of like just following a trend and trading when price is moving in one direction means that you know the probabilities of catching these runs is really high. Okay, you're not going to miss many of them. So you know, go away and do some back testing on it, but I think this is quite a nice middle ground, and it's certainly an option if you kind of like to trade this way. So that's all for now. Please leave me your comments, and I'll do another video soon.